Yes, hello everyone. This is Kyle Gilster, a member in Husch Blackwell's Financial Services and Capital Markets Group. We are excited to be talking with you today about Distilled guidance on the Paycheck Protection Program. Before we begin, I would like to cover a few housekeeping items. At the bottom of your audience console are multiple application icons for you to use during the program today. I would like to take a minute to highlight a few of the key icons for you. If you have any questions during the webcast, please submit your question via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, it will be answered later via email. We truly appreciate audience participation and encourage you to submit questions. There is also an icon to assist you with your viewing preferences. Accordingly, please note that you can expand your slide area by clicking on the maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. If you're having any technical difficulty, please click on the help icon. It has a question mark and provides information regarding common technical issues. A copy of today's slide deck and additional materials are available in the resource list icon that looks like a folder at the bottom of your screen. A recording of the webcast will be available tomorrow for watching and sharing. Once available, a link to the recording will be emailed to you. Joining me today is Kirsten Salzman and Jessica Zadoraski, both with the Financial Services and Capital Markets Group. Kirsten is a partner in our Kansas City office, and Jessica is a partner in our Milwaukee office. Now we'd like to begin. As lawyers have to do, I first have to read a disclaimer. The information provided during this webinar does not and is not intended to constitute legal advice and does not establish an attorney-client relationship. Instead, all information, content, and materials presented in this webinar are for general informational purposes only. Listeners should contact their attorney to obtain advice with respect to any particular legal matter. As it relates to the CARES Act, I wanted to do a brief overview. Clearly, the CARES Act is a historic piece of legislation in response to the COVID-19 pandemic. It is the third in a series of stimulus bills that Congress passed and the President signed into law. The first phase was just a general $8 billion appropriation for the federal government to ramp up for COVID-19. The second phase dealt primarily with paid sick leave and other related items. And then phase three, among other things, dealt with sustaining small business payrolls. And phase three was the CARES Act. Today we're going to talk about three programs that are referenced in the CARES Act. The first is the Paycheck Protection Program. The second is the Economic Injury Disaster Loans, called EIDL, and the emergency grants which accompany them. And lastly, the SBA subsidy of existing loans. I want to briefly talk about the PPP program, as it's called, the Paycheck Protection Program. Congress authorized up to $350 billion for the PPP. Just to tell you the warp speed in which Congress and the federal government have been operating, the CARES Act was signed into law on Friday, March 27th. A week later, on Friday, April 3rd, the interim final rule came out, as well as some banks started taking PPP applications. Other banks waited for additional guidance over the weekend and then started taking PPP loans as of that Monday, April 6th. That is warp speed for Congress and the federal government. And with that warp speed, obviously comes some ambiguities that everyone is still working through, and the regulations have helped give some guidance on. Just to give you a sense of the enormous demand on the PPP program, estimates have rated that the PPP has been expended, or I should say approved, of loans at about $3.5 billion an hour. Moreover, the American Bankers Association yesterday reported that of the $350 billion, approximately $205 billion has already been claimed, and this number represents applications that banks have processed. So with that being said, obviously there's enormous demand. At the end of the program, I'll talk a little bit more about a potential fourth stimulus and what Congress may do then. At this point, I would like to turn it over to Kirsten to talk about the PPP.
Thank you, Kyle. As Kyle mentioned, my name is Kirsten Salzman, and I'm a partner in our Kansas City office. I also chair our Corporate Securities and M&A Practice Group. I just want to take a moment to welcome you all to our webinar today and say that I hope each of you are doing well and that you and your families are both safe. Kyle gave you a great overview of the CARES Act and the various provisions in it that provide financial assistance to businesses in our economy. And now Jessica and I are going to get into more of the particulars. I'm going to spend time talking about the $350 Payroll Protection Program, and then Jessica will get into some detail on the EIDL loans and grants, and then the SBA subsidies for existing loans. Before I dive in, as Kyle mentioned, this historic law was passed into law on March 27th, and the first loan applications were accepted a week later on April 3rd. As a result, there has been a lot of uncertainty and constant updates and guidance coming out of both the SBA and the Department of Treasury. So one practical piece of advice I'd just like to start out with is before you apply for a loan or if you have any questions, the SBA and Treasury on their websites each have guidance as well as Q&As that are literally updated daily. So it's wise to always look at those two sources for information. So what I'm going to start out with is the Payroll Protection Program and who's eligible to receive assistance under this. Generally, there are 4 categories of businesses or enterprises that are eligible for assistance. The first is any business, 501c3 nonprofit organization, 501c19 veterans organization, or tribal business with not more than 500 employees. And we'll talk a little bit more about that 500 employee number later. Another is any business that meets the SBA-based size standards for the industry in which it operates. And this is the size standards are based upon your NAICS codes, and whether or not, so if you have a NAICS code that allows for a higher number of employees than 500, you're able to use that NAICS code for determining your eligibility. And you're able to find those employee numbers on the SBA website. There's a way to figure out what your NAICS code is and what's your permissible number of employees. The third category is any business that is a small business concern as defined in the SBA Act and meets the SBA employee-based or revenue-based size standards for its industry. Again, this is based on NAICS code. And I want to take a minute to just talk a little bit about what a small business concern is. Under the SBA regulations, a small business concern is identified and defined as an organization organized for profit that has a principal place of business in the United States and operates primarily in the United States and makes a significant contribution to the U.S. economy through the payment of taxes or the use of American products, material, and labor. And the fourth category is known as the alternative category. And this is any business that is a small business concern, which we just talked about under the SBA's alternative size standard as of March 27th, 2020. And this standard is met if the business has not more than $15 million of tangible net worth and an average net income of less than $5 million for the last 2 fiscal years before the date of application. And that $5 million net income tax is after $5 million net income test is after federal income taxes and does not include any carryover losses. In determining whether or not you're eligible for the Payroll Protection Program, there's a few additional considerations. First, it's clear under the Act that sole proprietors, independent contractors, and certain self-employed individuals are also eligible. There are also a few exceptions and clarifications or caveats on the 500 employee test. Businesses that have a NAICS code that begin with 72, which are primarily businesses in the accommodation and food service industries, may have more than 500 employees, so long as there are not more than 500 employees in any one physical location. The 500-person test is based upon, you have two choices. You can either base it upon the average number of employees in the 12 months preceding your date of application, or the average number of employees during 2019. In addition, the SBA has identified certain ineligible businesses, and most businesses are not going to be covered in this, but they're generally businesses engaged in lending, passive businesses owned by developers and landlords, businesses engaged in illegal activities, and certain speculative businesses, such as oil wildcatting. So as you can see, the number of employees is probably one of the biggest criteria for determining whether or not you're eligible for a Payroll Protection Program loan. And to calculate the number of employees, we talked about the time period, but also the SBA has a concept of affiliation. And in determining whether or not you satisfy the 500 employee test, you have to include employees of all affiliates. And affiliation under the SBA regulations is a very broad concept based upon control. And it's clear that if a person has the ability to control or owns more than 50% of the voting securities of an entity, it is an affiliate of that entity. Also, if two entities have common management or board control, they're deemed to be affiliates of each other. So you would have to add those employees together of those entities for determining if the 500-person test is met. It's also important to note that the SBA can find control when you do not own more than 50%, and it can be based upon what is called negative control, meaning that you have the power to block the board or the shareholders of an organization from taking certain actions. And in general, there are two types of negative controls, and this applies in the context of when a business has outside investors primarily, whether it's venture capital or private equity or just outside investors. If the outside investors have the ability to prevent the board from taking action, they can be deemed to have negative control. And to drill down on that a little bit further, the SBA has said negative control that protects your investment is okay, and you will not be deemed to be an affiliate based upon just the negative control. And those things are things such as an ability to block the sale of a business. That is a decision that would affect your investment. But negative blocks over operational, day-to-day operations, such as setting employee salary, et cetera, do create a negative control that's sufficient to create an affiliation. So you have to be very careful when you're thinking about whether or not you have the 500 employees. There are certain statutory exceptions from the affiliation rules that will not apply to these businesses. One is with a business with a NAICS code beginning with 72, as we already talked about. Those are accommodation and businesses in the accommodation and food service industries. Certain franchises have exceptions, as well as businesses receiving financial assistance from a small business investment company. And that financial assistance can be in the form of debt, equity, debt with equity features, or guarantees. And I also just want to take a brief minute. It's a little bit beyond the scope of this presentation, But religious organizations have broad exceptions from the affiliation rules, and the Treasury and SBA have come out with guidance that determine affiliation for religious organizations. So if you're a religious organization, you need to look at that guidance to determine the scope of an exception from an affiliation rule. So once you determine you're eligible, the next thing that's probably the most important is how much are you able to get. As Kyle mentioned earlier, the money, there's a huge demand for this money. And the statute clearly says that you're entitled to the lesser of $10 million or 2.5 times your average monthly payroll costs. So key things here are, how do you determine your average monthly payroll costs? Well, step one is you get, again, 2 periods of time from which to determine your payroll costs. One is in the 12 months prior to the loan or during 2019. You take that number, you divide it by 12 to calculate the average monthly payroll, and you multiply that by 2.5 times. I note here, just a matter of practical advice, a number of banks have put together spreadsheets that will help you calculate the average loan amount. All right, as you can see from the loan calculation slide, what constitutes payroll costs is very important into this determination. And the statute is very clear that salaries, wages, commissions, and other similar compensation is included, cash tips, vacation, parental, family, medical, or sick leave, separation payments, group health care benefits, and retirement benefits. What's not included and what is excluded from the calculation of payroll costs and thus your ultimate loan amount are cash compensation, and I highlight that word cash compensation in excess of $100,000 per year to any one person. So this, in determining whether how to include the payroll costs associated with a person who makes over $100,000, first of all, it's an annual calculation. And it's important to note that if their cash compensation is in excess, the amount of cash compensation in excess is what's excluded. So, quick example, someone makes $150,000, you can clearly include $100,000, but not the $50,000. Just another example for the cash compensation component. If you have somebody who makes $95,000 in cash compensation, but you pay an additional $15,000 of benefits on top of that, so their aggregate compensation totals $110,000, you can include the entire $110,000 because the cash compensation is $95,000 and is less than the $100,000 threshold. Also excluded are compensation to employees whose principal residence is outside of the U.S., qualified sick leave and qualified family leave wages for which a credit is available under the Families First Coronavirus Response Act, which Kyle mentioned was the second part of the legislation. If you're getting a tax credit for those wages, they cannot be included. Payments to independent contractors are not included. And also taxes that the employer withholds on behalf of the employees can be excluded, but taxes that the employer pays out of its own pocket for the benefit of the employees cannot be included. So once you receive this money, you calculate your payroll costs. The statute has made it very clear that there are only certain permissible uses of the loan proceeds. One, obviously, is to pay the payroll costs. Two is to pay costs related to the continuation of group health care benefits during periods of paid sick, medical, or family leave and insurance periods. Payments of interest on mortgage loans, rent, utilities, and interest on other debt incurred prior to February 15th, 2020. Now, it's important to note two things. One, that this interest on other debt, not mortgage debt, but other debt incurred prior to 2015 is not eligible for forgiveness. And the SBA has come out with interim guidance saying at least 75% of the loan proceeds must be used for payroll costs. And if you think about it, the incentive of this statute and the policy behind it is to keep people employed. So they want to make sure that 75% of the loan proceeds are used for payroll costs. Next, I want to just spend a brief moment talking about the application process. This is not on the slides, but in the application, it's a standard form application, and everybody's required to make certain certifications. The first is that the business was in existence on February 15th, 2020, and has paid salaries and payroll taxes to employees or has paid independent contractors. Then one of the other certifications is that the economic uncertainty surrounding the coronavirus pandemic makes the loan necessary to support continuing operations of the business. This does not mean that you have to have, and what this means is at a very high level that you have to have a realistic belief that you will be laying off or reducing the salaries of your workers without the benefit of the loan. It's not a financial needs test. It's a financial uncertainties test. You don't have to say you're out of money at the bank, but you have to say that the situation that we're all going through right now creates a level of uncertainty that this loan is necessary. You also, as part of this, we think it's a best practice and some banks are actually requiring it, to put forth a statement of necessity or a statement in support of your loan. Some banks, as I said, are requiring it, and if they aren't, it's our advice that you take a moment and write down and document why you think this loan is necessary and how your operations are impacted and what you realistically think your business would look like without the loan. And then finally, one of the other certifications is you have to certify that your funds will be used for the permissible purposes that we talked about earlier: payroll costs, interest on mortgage, rent, utilities, etc. It's important to note here that this is a program is being administered through traditional commercial lenders. Unlike the EIDL loan that you'll hear about in a few minutes, you apply with a commercial lender that is approved by the SBA. You do not apply with the SBA or the Department of Treasury. But both of them have on their website lists of commercial lenders that have been approved. Each lender, I've seen this happen, each lender has their own procedures, forms, and approval processes. So our strong advice is if you're interested in one of these loans to reach out as soon as you can to your banker and understand their process. It can be cumbersome, especially if you have to open up a new bank account. It can take time. And lenders have also been saying that they're going to prioritize providing these loans and financial accommodations to their current customers. So if you have a relationship with a bank, your first source of this loan should be with them if they're a SBA approved lender. Finally, the statute requires that the lenders make the first disbursement of the loan no later than 10 calendar days from the date the loan is approved. All right. The next component, and probably one of the most attractive components of this financial loan and financial accommodation, is it's eligible for forgiveness. And I just want to, again, reiterate our guidance that we're going to be giving here is based upon the current law. We've seen over the last 2 weeks significant interpretations come out of the SBA and Department of Treasury, clarifying how and when people are eligible for the loan. As you can imagine, they haven't spent a lot of time giving a lot of guidance on the forgiveness just because the questions haven't started coming up yet. So what we're telling you now is based upon the current law and guidance, and again, strongly recommend that you look at the Q&As on the Department of Treasury's website almost daily, because everything's getting updated daily. So as I said, the loan obligations are eligible for forgiveness if the proceeds are used to cover eligible costs during the 8-week period beginning on the date the lender makes the first distribution of the PPP. And I emphasize the amount forgiven has to be used during the 8-week period beginning on the date you get the loan. And the eligible costs for forgiveness are payroll costs expended, again, excluding compensation on employees in excess of $100,000, payment of interest on a mortgage, payment of rent, and utilities. Note here, again, that if you paying interest on other debt obligations is a permissible use, it will not be eligible for forgiveness. Again, reiterate that 75% of the loan proceeds must be used for payroll costs to get the forgiveness. And there are exceptions to the forgiveness. There's ways that the forgiveness amount can be reduced. And these include if you reduce the total number of your total number of employees during the period from February 15th through April 26th, compared to a period in the prior year. They give you a period of time in 2019, or there's two different periods. If that number has been reduced, your amount of forgiveness is reduced. So just a quick, easy example, if you have 90 employees in the period from February 15th through April 26th, and during the comparable period you had 100 employees, thus you've suffered a number of employee reduction of 10, only 90% of your loan will be eligible for forgiveness. The other way the amount that is forgivable can be reduced is if there is any reduction in the compensation of employees in excess of 25%. So if you reduce your employees' compensation by, say, 5 or 10%, that will not factor into the reduction in compensation, but if it's over 25%, it will. And also there is, again, a caveat or exception for individuals over $100,000 that get over $100,000 of compensation in a year. You can reduce their salary by more than 25%, and it will not affect the calculation. You can see that the share preference in this act for preserving middle-class salaries and wages. So another thing that's very important is the statute is very clear that says the forgiven amount is not taxable as forgiveness of indebtedness income. But I do caution you, there is some uncertainty in the law right now as to whether or not businesses will get ordinary tax deductions for the payment of salaries. Under Section 265 of the tax code, deductions are disallowed if they are funded with tax-free income, and there's a question out there right now as to whether or not that tax code was intended to be overridden by this Payroll Protection Act or not. This has clearly been, excuse me, brought up to the Senate Finance Committee, and we're hoping that there'll be additional guidance out there, but one area to keep your ear to the ground about. Finally, The amount of the amount of the loan that is not forgiven turns into a loan that has to be paid back to the financial institution. The loan is a 2-year loan that carries interest at 1% a year. The interest and principal on these loans are deferred for the first 6 months after the funds are dispersed, but interest will continue to accrue. And I just want to take a quick moment to highlight the fact that if you get a payroll protection loan, you cannot take a payroll tax credit. The current CARES Act allows employers to defer payment of payroll taxes into 2021 and 2022. You cannot simultaneously take the payroll tax credit and the PPP loan. And again, if you're getting an employee retention tax credit, you're not eligible to take that at the same time as the PPP loan. So with that, I am going to turn it over to Jessica, who is going to discuss EIDL loans, emergency grants, and SBA subsidies.
Thank you, Kirsten. Good morning, everyone, and thanks again for joining us today. I too hope that you are all well. My name is Jessica Zaratsky, and as Kyle mentioned earlier, I'm a partner on the financial services team at Husch Blackwell, and I'm located in our Milwaukee office. So the PPP loan program that Kirsten just discussed has, understandably so, been a focus for small businesses during these unprecedented times. For the first time in history of the U.S., a major disaster has been declared in all 50 states at once. And so we also wanted to take a couple minutes of your time this morning to highlight another form of relief that is available to eligible small businesses, and that is the SBA's Economic Injury Disaster Loan Program. You may also hear it being referred to as an EIDL or a disaster loan. So an EIDL is a low-interest federal loan that is issued directly by the U.S. Treasury, and this is as opposed to the SBA-approved lenders that are making the PP loans that Kirsten just talked about. So applicants can go on to the SBA's website and fill out an applicant directly there. The CARES Act added $30 billion to the existing disaster loan fund, and these loans are available from January 31st through September 30th of 2020. So who is eligible for these disaster loans? In addition to sole proprietors and independent contractors and most private nonprofits, we also have small businesses, cooperatives, employee-owned businesses, and tribal small businesses with 500 or fewer employees that are also eligible for these loans. There are also businesses in certain industries that may have more than 500 employees, and in order to qualify, they have to meet the SBA's size standards for those industries. Also importantly, the borrower must have been in operation since January 31st of 2020 when the COVID-19 public health crisis was announced. Some of the key details of these disaster loans are that the maximum amount of the loan is $2 million, although I do want to point out to you that recent communications from the SBA indicate that due to the large volume of applications and the current appropriations for the program, the initial loan disbursements will be limited to 2 months of working capital, up to a maximum of $15,000 per applicant. The interest rate on these loans is set at 3.75% for small businesses and 2.75% for most private nonprofits. And while the interest will begin accruing on day 1 of the loan, payment is automatically deferred for at least 12 months. The term of a loan can be up to 30 years in the discretion of the SBA. Loans under $200,000 are not going to require personal guarantees. The maximum unsecured loan amount is $25,000, and the SBA has waived its credit elsewhere test, meaning that small businesses that have credit available elsewhere are now eligible for these disaster loans. It's important to note that these are working capital loans, and so the funds can only be used for certain purposes, which include payment of fixed debts, payroll, accounts payable, rent or mortgage payments, and some bills that could have been paid had the COVID-19 declared disaster not occurred. The CARES Act also established a $10 billion emergency grant under the Disaster Loan Program. And these grants have been backdated to January 31st to allow those who have already applied for the disaster loans to be eligible to also receive the EIDL grant. Some of the key details about this emergency grant include that an eligible entity that has applied for a disaster loan through the SBA's website due to COVID-19 may also request an advance on that loan up to $10,000. And recent communications from the SBA indicate that the amount of this grant will be calculated at $1,000 per employee and capped at the $10,000. The applicant must also certify that it is an eligible entity under the SBA guidelines, and then the SBA is required to distribute the emergency advance to the applicant within 3 days of the applicant's request. Although, as a very important side note, we do understand that in practice, this is likely not the case, and that many businesses that have submitted their applications dating back to mid-March are still waiting to receive a response from the SBA. This advance can be used towards paid sick leave to employees, payroll, increased cost of materials, rent or mortgage payments, and repayment of other obligations that cannot be met due to revenue losses. And very significantly, this advance does not need to be repaid, even if the applicant is subsequently denied the disaster loan. However, if the business also receives a PPP loan, the amount of any loan forgiveness that Kristen covered and went over earlier on the PPP loan will be reduced by the amount of any disaster loan grant that is received. So this is just something important not to lose sight of. It's also important to note that a business can receive an EIDL loan and or the emergency grant and can also get a PPP loan. However, the loan proceeds from each of these cannot be used for the same purpose. So in other words, there can be no duplication in the uses of funds, no double dipping. But again, there is an ability for small businesses to obtain relief under both programs, the PPP and the EIDL programs. But because this disaster loan program remains very fluid and we're seeing additional SBA guidance come out, businesses should follow up directly with the SBA Office of Disaster Assistance. I understand that contact information is available to people on the application once you receive an email that allows you to confirm that you did successfully submit your application. I do understand that the SBA Office of Disaster Assistance contact information is directly included on that email confirmation. It can also be found on the SBA's website. You can also locate your state's SBA district office through a search on the SBA's website. And then also, we at Husch Blackwell continue to monitor this program for additional important developments. There's also another very important piece of the SBA relief under the CARES Act that is not getting as much attention as the PPP and the EIDL programs, and that is for small businesses that have existing SBA loans through the SBA 7A, 504, and microloan programs. The SBA is subsidizing these loans up to an estimated amount of $17 billion. And key details about this subsidy program include that the SBA will automatically pay the principal, interest, and fees that are owed on these existing loans for a period of 6 months, and that starts on the next payment due date. And for those existing loans that are already on deferment, then the SBA will begin making these payments with the first payment after the deferral. And also, the SBA is going to automatically pay the principal, interest, and fees of any new SBA 7A, 504, and microloans that are issued prior to September 27th of this year. So for any business out there that has an existing SBA loan under one of these 3 programs, it's important for you to follow up with your existing lender directly so that you can have these discussions and make sure that the measures are in place for you to take advantage of this subsidy program. And with that, I will turn it back to Kyle, who has some important final tips for you as you guys move forward. Thank you.
Thank you, Jessica and Kirsten. Obviously wanted to give you some final tips before we open it up for question and answer. I think it's very important to maintain the appropriate documentation to justify the costs for PPP and EIDL. This is important, obviously, for purposes of your lender for PPP and for purposes of EIDL with respect to the SBA. This obviously goes without saying. What makes this program so lucrative is the loan forgiveness side of it. So you don't want to go to all this work and get approved for the loan and then don't ultimately file for loan forgiveness. You need to file the loan forgiveness application with your SBA PPP lender after the 8-week period, which was referenced earlier. Also, I think it's important to consider the other SBA programs and other tax-saving opportunities under the CARES Act. The 504 program that Jessica mentioned, I think is a very good program as well. One thing to bear in mind with respect to SBA is before the CARES Act, and it still is, it's a relatively small federal government agency and with a very limited but effective bandwidth. The pressure that they have been put on in a short amount of time has obviously tested them in terms of the IT side of it, the people side of it. That's one of the reasons why the Department of Treasury has become very active in terms of where all these different interim final rules are and other FAQs and other questions. They're on the Treasury website as well, so Treasury continues to be active there. At the beginning today, I referred to a potential fourth stimulus, a stimulus 4. I mentioned earlier that there was an effort to try to get $250 billion extra into the PPP. That was last week on Thursday. There was a unanimous consent motion on the Senate floor that was objected to. I think the idea is that there's going to be an effort to maybe try to couple the SBA PPP funds with some additional healthcare funds. It remains to be seen when that money will be allocated and appropriated. I do expect ultimately that it will. We may just need to get a little bit closer to the point that there are no funds left. I've even seen it speculated at the end of the day, this could even be a $1 trillion program. So I think that's important to bear in mind. It is also possible that as part of a stimulus 4 or a stimulus 3.5, as some have said, there may be some effort to make some technical corrections as it relates to the PPP. I know there's been some push as it relates to the private equity side on the affiliate rules, potentially to make some changes, as well as what are eligible expenses under the PPP. So that is one thing to watch. I also think when Congress ultimately gets back to D.C., which is where I live, I think there could be some congressional hearings and congressional scrutiny to make sure that the money ultimately for PPP and EIDL was expended as they had hoped it would be expended. Lastly, I did also want to briefly point out that there are programs available for non-small businesses under the CARES Act as well. There's a mid-sized business program. There's as well as 2 Main Street lending programs that the Federal Reserve is getting up and going, and we're happy to be a resource on that as well. With that said, I hope everybody stays healthy and well, and I'd now like to open it up for question and answer. It looks like we have a good large number of question and answers as we expected. I'll turn it over to Kirsten to field the first question. Go ahead, Kirsten.
All right, thank you, Kyle. The first question is, what is the definition of average number of full-time equivalent employees for the forgiveness calculation? And this question, I'm going to answer the question and then I'm going to highlight another point that I want to make. There is in the statute as it stands now, in the payroll protection portion of the CARES Act statute, there's not a definition of the average number of full-time equivalent employees. Elsewhere in the CARES Act, that term has been used, it has been defined by reference to the Obamacare definition of average number of full-time equivalent employees. And that's what we expect, and that's what we think the answer is. Is it determined by reference using the same definition as the Obamacare, which is based upon a 30-hour work week. And I just want to take a moment here and stop and point out that there's a difference between employees for forgiveness and employees for determining whether or not you're eligible. In calculating the eligibility criteria, you count all full-time, part-time, or otherwise employed individuals in that 500-person number. But then when you do the forgiveness, it's based upon the number of average full-time equivalent employees. So I recognize that's kind of an inconsistency in the statute, but that's where it is for now. Jessica, do you want to take the question?
Absolutely. So we've got a couple of questions that I'm going to do a hybrid of here. And Kristen, I do think you addressed these in your slides, but I think it's important to reiterate these. One of the questions is, when does the 8-week spending period begin? Is that when the SBA completes underwriting or when the bank approves the loan? And actually, the answer to that is that the 8-week period begins on the date that the loan money is dispersed to you, and you have that, and you have an ability to spend it. So that is when your 8-week period will commence. And another question that kind of leads into this is whether or not a business should set up a separate bank account for which those funds would be dispersed into, to just be able to track that and make sure that those funds are not commingled with the business's other funds. We don't see that as a requirement, but we do see that as a good practice and something that you should discuss with your bank, because I know banks are very taxed right now in processing these applications. So we are hearing that some may not be in a position to be able to open up new accounts right now and to worry about transferring those funds. Another consideration is that you should talk with your third-party payroll provider if you do use one, because usually they are linked to a certain bank account from which they pull funds in order to process your payroll. So to the extent that you are going to open a new account for the purposes of the 8 weeks in spending the payroll protection funds, you should just make sure you've also coordinated that with any third-party provider that you use.
I'm happy to field a question. This is Kyle. We've had a few questions asked about NAICS codes and how do I get one and where do I find mine. The NAICS is a self-assigned system that you designate which code best fits your industry. And actually, if you go to www.naics.com, there is a lookup tool and a search tool which can help you designate which code you best fall under. So with that, I'll turn it back over to Kirsten.
All right, I'm going to take a number of questions and try to aggregate them into what monitoring is required after, of the bank after they fund. How am I going to show, and this goes a little bit to the question of the separate bank account. But the statute is very clear on the fact that you are going to have to prove and provide documentation to show your forgiveness calculation. And for the number of employees and the amounts you're paying, the statute mentions payroll tax filings, state income payroll, and unemployment insurance filings as sufficient documentation. For other expenditures, the statute mentions checks, canceled checks, payments, receipts, transcripts of accounts, anything that you can really do to verify. It's going to be a document-intensive process, and you're going to have to come up and show what the money was used for before they're going to give you that forgiveness. Jessica?
Thanks, Kristen. Yeah, that was a good point. Also, another question and some points that I'm seeing some questions on that Kristen touched on briefly regarding eligible payroll costs, and that's dealing with independent contractors and sole proprietors, whether or not payments that an eligible borrower has made to an independent contractor or a sole proprietor has to be included in the calculation of the borrower's payroll costs for its PPP application. And again, the answer to that is no, that if a borrower has paid an independent contractor or sole proprietor, that's excluded from the payroll costs. And this goes back to the fact that independent contractors and sole proprietors are themselves eligible for a PPP loan if they satisfy the requirements. And the form of the borrower application that is out and available on the Treasury's website does include a category for sole proprietors and for independent contractors. So there is not a separate borrower application form for those folks, and they should be using that form that they can find updated on the Treasury website.
In terms of another question, I see some have asked about how PPP and EIDL interact. And the issue is effectively, can you double dip for the same expenses that you get for the PPP loan that you get for the EIDL loan? And the answer to that is no, you cannot. One also important thing to factor in is if you do apply for both EIDL and as well as PPP and you get that $10,000 grant under EIDL, ultimately, if you get PPP, that has to be applied toward your PPP loan as well. So I'll turn it back over to Kirsten. Or Jessica, or any other questions that we might have.
Sorry, I was on mute. I apologize. I've been seeing a number of questions on what constitutes a qualified mortgage payment or a qualified utility payment or rent payment. A couple of key points. I think when they say mortgage, they mean mortgage. A mortgage is a secured lien on a piece of property, so it's really payments on real property. I wouldn't interpret that to mean any other secured debt, such as payments on, debt that was secured by other assets or secured by a car or a vehicle. I don't think that's the statutory intent. The other question is what constitutes utility payments, and the statute defines it as electricity, gas, water, transportation, telephone. Doesn't specify landline or cell phone. It just says telephone or internet access. And with respect to all of these, whether it's a rent obligation or a mortgage obligation or a utility, the service or the loan has to have begun before February 15th, 2020. So I think that's an important date to note. Jessica?
Sure. I'm also seeing some questions regarding nonprofits and eligibility under both the PPP program and the EIDL programs. So I just wanted to briefly touch on those. With respect to the PPP program, so traditionally under the SBA 7A program, nonprofit organizations are not eligible for SBA guaranteed loans. But for the purposes of this PPP program, the SBA did open eligibility up to 501c3 nonprofit organizations and 501c19 veterans organizations with not more than 500 employees. So we have not seen that other 501c or other private nonprofit organizations are eligible for the PPP program. However, the EIDL program is available to private nonprofit organizations that currently have an effective ruling letter from the IRS that grants tax exemption to them under Section 501c, D, or E, or if the private nonprofit organization does have satisfactory evidence from the state that the non-revenue producing organization or entity is a nonprofit one organized or doing business under state law. So we do have that, but it's also important to keep in mind that the EIDL program does still contain some ineligible categories. So for folks who, may be one of those private nonprofits, but are engaged in the business of lobbying or any other businesses that are engaged in, any sort of illegal activity, lobbying, any state, local, or municipal government entities, those folks are still not going to be eligible.
I'll take the last question. We've had many questions on the agriculture side of things, and the issue as to whether or not farmers and ranchers are eligible to apply for PPP, and the answer is they are. The interim final rule, which was released in early April, clarified that, and they're subject to the eligibility standards that were referenced earlier. With that being said, thank you so much for all the great questions that were asked today. Thank you for all joining us for our program today. We hope the information provided was helpful for you and your organization. If you have not already, please click on the survey icon at the bottom of your screen to complete our short survey. Your feedback assists us in providing quality future programs. As a reminder, a recording of the webcast will be available tomorrow for watching and sharing. Once available, a link to the recording will be emailed to you. I hope everybody stays healthy and well. This concludes our webinar. Thank you.